Hello guys, this is Augusto and welcome to class 7 of the Corporate Finance module. And today we are going to talk about M&As, mergers and acquisitions. So a very interesting topic. It doesn't matter in which sector do you work, in which area do you work. Your career and your life may be impacted for a merger or an acquisition. It can be your professional life if your company is involved. It can be your life as a consumer of any product or service that you are a fan, that you consume. So this is a very interesting topic. So let's go to the slides. We have here class 7. In this class, as I mentioned, mergers and acquisition, and as it is a very complex and rich topic, we will only talk about mergers and acquisitions in this class. So to start, some M&A examples. I selected some of the biggest M&As in the world, and I also included one that everybody knows and that is extremely relevant. So let's take a look at this list. Some of the most famous mergers and acquisitions. We have Vodafone and management. So Vodafone, the telecommunications company, acquired management. That is a German conglomerate for $202 billion. This was in 1999 and it's still the biggest merger or acquisition case. Another interesting thing, we always say mergers and acquisitions. In reality, we always have one company acquiring another one. So it's always the case that one company is acquiring the other, but the other will be merged inside this company. This is why we don't say simply acquisition. The second one was AOL and Time Warner, $182 billion. The third biggest one was Dow Chemical and DuPont, so two gigantic companies, $130 billion. Another very relevant one was AB InBev, and just by the name of AB InBev, you already see that you had a lot of integrations and mergers before, right? Because we had in Brazil Antarctica and Brahma, and then it formed Ambev. And then Interbrew kind of acquired or merged, and we have InBev. And then we had the merger with Anheuser-Busch, Budweiser, so AB InBev. And they later acquired SABMiller. So this transaction involved the amount of $107 billion. Heinz and Kraft, another very big one. And later on they made a bid for Unilever, but they didn't reach an agreement. So imagine the size of what this deal would be. Pfizer and Warner Lambert, so two gigantic companies from the pharmaceutical sector. And I included one that is more recent and everybody knows, but it's an interesting case because of what this merger generated. We had Facebook and WhatsApp, $22 billion. A lot of people thought at that time that Facebook had overpaid for WhatsApp. But imagine the size of the company now, the value of the company now. So definitely it was a good choice, okay? So M&As, they are very tricky. A lot of times the market in general may think that a company overpaid for another one. And at the end of the day, as years go by, they see it was the right decision. And sometimes they think it was a good deal, but after some years they realize, no, it was an awful deal. And let me make the screen bigger now, because we have different kinds of merger. We have a horizontal merger. A horizontal merger happens when we have a combination of two firms in the same line of business. So for example, two banks. In Brazil we had Itaú Unibanco. It is a horizontal merger. Or as we've seen in the previous slide, Pfizer and Warner Lambert, two pharmaceutical companies. We have a lot of movement in the pharmaceutical industry. So every time we have a combination of two firms in the same line of business, we have a horizontal merger. We also have vertical merger that happens when it involves companies at different stages of production. So imagine Unilever, for example, okay? And let's pick one of the products. So the ice cream, okay? One of the lines of ice cream. It changes from country to country. It can be called Carte d'Or, in some countries, Kibon. But imagine that Unilever, and let's pick the ice cream line of products. What would be a vertical integration? They could acquire the company that produces the raw material or the main raw materials to produce the ice cream. Or they may acquire a distribution company to distribute the ice cream or their products. So in this case, you would be expanding your company in a way that you would control the different stages of the consumer chain from developing the raw materials until the distribution and sales to big supermarkets, for example. And we have a conglomerate merger that involves companies in unrelated lines of businesses. So the principal mergers, especially in the 60s and the 70s, in which markets were not very consolidated, were mostly conglomerates, okay? So conglomerates are less popular now. Companies prefer to focus on their core business, but in the past, it was more common to have conglomerates. In which country do we have very famous conglomerates until nowadays? In South Korea. So if you pick Samsung all around the world is well known for mobile phones and for TV sets, televisions. However, in Korea, they have all sorts of business, from agriculture to, I don't know, many different areas in which they are involved, okay? Why conglomerates are not famous anymore? Because with conglomerates, it's harder for you to have the benefits of a merger and acquisition because you don't have the economies of scale. So economies of scale are one of the main reasons for which companies search for a merger or search for acquiring another company, especially when we talk about vertical integration, okay, or vertical mergers. What does it mean, economies of scale? It means cutting costs by getting bigger through synergies between two companies. So we had, for example, Heinz and Kraft. They are both consumer good companies from the food sector. When you merge these two companies, would you need two accounting teams? Would you need two human resources teams? No. So this is what you get with economies of scale. You can streamline the company, okay? You will need, in general, you would need less employees because you will not need two complete company structures to run the business, okay? So there will be synergies, of course. They will not fire everybody from the other company, but they would be able to streamline, to reduce, and to become more efficient. There are a lot of benefits with big mergers in terms of cutting costs. And what are the economies of vertical integration? Here I said vertical, but I meant horizontal, okay? With horizontal integrations, you get these large economies of scale. When we talk about economies of vertical integration, we are talking about gaining control over the production process by expanding back. So this is what I mentioned. If you produce a specific product, you buy the supplier that prepares the raw material and sells you the raw material. Then you are expanding back and you are controlling the output. Or you can expand forward to the ultimate consumer. So imagine if a consumer good company decides to create its own supermarket chain to sell its products direct to the consumer. Okay, this would be another example of vertical integration. What are the advantages? You cut the margin, right? So, for example, when I worked at Rect Bankser, they produce household cleaning products. So let's say Vanish, for example, there is a global brand. And of course, you had to acquire the bottle, the package from another company. If they decided to acquire this company, they would have the cost to produce the bottle, but they wouldn't have to pay the margin that, of course, the company that is selling them put in the products. Okay, so these would be the benefits of vertical integration. And consequently, your final product would be cheaper. Complementary resources. So many small firms are acquired by large ones for different reasons, okay? First of all, let's pick the example of Unilever that acquired the ice cream brand Ben & Jerry. So Ben & Jerry, even though it's a famous brand, was a very small business for Unilever size. So why did they acquire? Because companies they are targeting to become more sustainable, they want to be seen as green brands, so brands that respect the environment. And Ben & Jerry's was created with this motto. So it was created to be sustainable, to use organic ingredients, and so on. So by bringing this kind of company to inside the organization, it can help to shift the culture, or it can help to send a message to the market saying, look, we are trying to be more sustainable, or we have brands that are sustainable. What happens a lot as well are, for example, large banks and credit card networks as Visa and MasterCard acquiring small fintechs. So somebody creates a fintech with a very interesting solution, and the banks decide to bring their structure to inside the bank. Or in the case of credit card networks, they want to diversify their business, so they put the money that these companies need to grow, and they have, of course, a large stake in those companies. Or sometimes they acquire the company just to eliminate competition or a potential future competitor. And surplus funds. Buying another company for inorganic growth instead of paying dividends. What does it mean? Imagine that you have a lot of cash in the company. When you have a lot of cash, you have to do something. What would be your options? You can invest in something, or you can pay dividends. Okay, you can pay dividends to the shareholders. However, if you're not aggressive to grow, especially a public company, a company that trades shares in the stock market, you will send a message to the market that you are not aggressive enough, that you're not trying to grow, that you may not be as profitable as you are in the future. So companies, they prefer to invest this money, maybe acquiring other companies, rather than keeping a lot of cash or paying too much dividend, because even though it sounds it's good for the shareholders, they are receiving more dividend. However, it's not the right message to the market, and the stock value may decrease. Okay, so with surplus funds are a very important topic to any organization that accumulates a lot of cash. Okay, usually they need to have a plan, a clear plan of what they're going to do with this cash. And it helps eliminating inefficiencies. So, for example, poor management from one side may result in unexploited opportunities that can be solved by better management. And I will explain you with another example from Rect Bankiser, because it's a company that I worked there. And I worked there right after the merger of Rect and Coleman with Bankiser. And it was exactly the case that we are seeing here. So Rect and Coleman was a much bigger company. However, business was not going well, margins were low, the company was not well known for being innovative, and on the other side, you had a Dutch company called Bankiser that was much smaller, but they were growing very quick, in a very quick pace, and they were becoming well known for having an aggressive and very good management team. So what did Hecht and Coleman shareholders did? They decided to acquire Bankiser, but they kept the management team from Bankiser. So the management team from the smaller company took over the management of the bigger company, okay, and now the consolidated, the merged two companies. So this is very interesting thing in terms of mergers and acquisitions. And one of the cases that I know that is similar in Brazil was Vivo, the telecom company, acquiring GVT, that was a much smaller company, and also keeping a lot of the key players, a lot of the key members of GVT management team. So another case of a very large company acquiring a smaller one, but changing the management team. So let's talk about industry consolidation, okay? This is something very important in many markets, and many markets, they only survive through consolidation, okay? A lot of times, people think that consolidation is not good to consumers, but in some cases, it is necessary. We have a lot of consolidation in the shipping industry, for example. So I worked for a Danish group called AP Møller Maersk. They are a shipping company. Shipping is the main business. And when I joined the company, they had just acquired P&O Nedlloyd, that was the fourth biggest player. And recently, they acquired Hamburg Süd, that was maybe the third biggest player. And of course, other shipping companies acquired other shipping companies. Why? Because it's not an extremely profitable business. So if you have a lot of pulverization, you have a lot of players in the market, no one will be able to be profitable. Okay, it's a business that suffers a lot with the fluctuation in oil prices, for example. So it is a tough business, and you have a lot of acquisitions here because the market sometimes needs this consolidation for companies to be profitable and keep operating. Banks is another sector full of consolidation. So think about your country. How many cases of mergers and acquisitions do you remember? So, and sometimes it involves international banks as well. Here in Brazil, we had Santander acquiring Banespa, that was a very large company, a very large bank, state bank. And also you had, as I mentioned before, Itaú acquiring Unibanco, so you had two companies from the same country, and sometimes one bank from the local country acquiring the national operation of an international bank. So, for example, Itaú acquiring Bank Boston. Consumer goods sector as well. Companies are looking for economy of scale, and they need to share. They need to show growth to the shareholders. So this is why we have a lot of consolidation in this industry. Telecommunications, the investments, they are gigantic. Okay, I've had a student that was a controller in one of the three largest operators here in Brazil, and we were analyzing at that time Telefónica's balance sheet and income statement, and you could see that with the level of investment necessary for the company to keep up with the technology and provide a good service, you could not have a lot of players. Sometimes we as consumers think it would be nice if we had 10 choices of telecom companies, because then they would provide a better service. But this is technically impossible due to the size of the investments that these companies need to make. And to make investments, of course, you need to sell a lot to generate a lot of cash and profit. Pharmaceutical industry, similar case as consumer goods. We always have a lot of mergers and acquisitions in this area, looking for economies of scale. And now a more mathematical aspect. How do we estimate mergers, gains, and losses? So how do we decide if it's a good idea for a company to acquire another company? So imagine this situation here. You are a finance manager in company A, and you want to analyze the potential purchase of company B. First, you need to analyze if there is an economic gain from the merger. So you are going to analyze, we are company A, let's say we are 4 times bigger than company B. If we merge, if we bring company B inside our organization, inside our office, what would be the economic gains? What kinds of costs would be cut? Will we have a better distribution? Will we in any way be able to sell more? So what would be these gains? So an economic gain happens if the two firms are worth more together than apart. So after calculating what would be these gains, we would be able to see if the merger makes sense. If they together can be bigger than they are just separately. Because otherwise you would acquire a company and leave it as it is. You would not conduct the merger process. Okay, you would operate two separate companies, or you wouldn't make the acquisition. So the gain is calculated by the value of the two companies together minus the value of company A plus the value of company B. If the gain is positive, if this equation is positive, there is an economic justification for the merger. So you can proceed with the merger. But also, of course, you need to think about the cost of acquiring company B, right? It's not just putting them together and see if the value is bigger than their separate value, because in most cases it will be. But you have to consider the costs of acquisition. So the cost equals cash paid, and in this example, we are pretending that the entire acquisition will be made by cash, so paying the other company in cash, minus the value of the company, the market value of the company. So the net present value to A of a merger with B is measured by the difference between the gain and the cost. So it's very simple. NPV equals gain, that is the equation that we saw in the last slide, minus cost, that is the equation that we have seen here. And remember the first class, when do we approve a project? We approve a project when it has positive NPV. So let's see the example here. Company A has a value of $200 million and Company B has a value of $50 million. Merging these two firms would allow cost savings with a present value of $25 million. So, as a finance manager, you calculated what would be the cost savings when you merge these two companies, and this amount, bringing it to present value, is $25 million. So, this is the gain from the merger. Thus, we have the value of A 200 million, the value of B 50 million, the gain is 25. The value of the two companies combined are 275 million. So the 200 from A, 50 from B, plus the gain, you have the value of the two companies combined post-merger, okay? Now suppose that B is bought in cash for 65 million reais. Usually we need to pay a premium, okay? So if the market value is 50, it's not as simple as there and saying, okay, I will buy your company for 50. You would have to pay a premium to convince the shareholders to sell their shares, okay? So suppose B is bought in cash for 65 million. The cost is the cash paid minus the value of B. So you are paying here, the cost of the acquisition here is considered $15 million, okay? Because 50, you will still have it because you are bringing the company inside your organization and all its assets. So what is considered the cost in this operation is the difference, 15 million. So the stockholders of firm B are ahead by 15 million. Their gain is your cost. It's the premium they are receiving, right? So they've captured 15 million of the 25 million merger gain because the value of the companies combined would be 25 million extra, right? Remember that you calculated this cost savings that would be what will increase the company's value when they're combined. But 15 is the difference that you paid from what the company's market value is and what you had to pay in cash to acquire the company. So the stockholders in firm B, they kept this 15 million. So when we calculate the NPV, we are calculating the part of the gain stockholders of company A get to keep. In this case, the NPV is the gain minus the cost. The gain with the synergies, the cost savings are 25 million. The cost, the difference of what you paid and what was the market value of the company, was 15 million. So your NPV is 10 million. It's still a good NPV. In terms of corporate finance theory, you should accept the deal. So let's check the math calculating it in a different way. The NPV is your wealth with the merger minus what would be your wealth without the merger. In the equation, it means the value of companies A and B combined minus cash that you had to pay to acquire the company minus the present value, the value of company A. 275 is the value of companies A and B combined. Why 275? Just to recap, 200 million from company A, 50 million market value of company B, 25 million the gains, the cost savings you will obtain with the merger. So the value of companies A and B combined, 275, minus cash, the 65 million you paid to acquire, minus the wealth without merger. What is the wealth without merger? It's your current market value. The current market value is $200 million. So we have 10. Okay, so the NPV is 10. This is just another way of calculating and showing you that the account is correct. So why is this approach better than calculating the discounted cash flow, something we have done in class 2 of the target company, including merger benefits? What does it mean? In our example here, let me just go back. So in our example here, we estimated what would be the cost savings if we merge company A and company B. So we considered the potential synergies and we calculated this $25 million. When you do this, it's not a very hard task to do. You can do with a certain level of certainty. If you calculate the discounted cash flow of company B for, let's say, the next 5 years and bring it to present value, you would have a lot of variables involved. So imagine that you are the CFO or the finance manager of company A. You have one alternative that is estimating this cost savings from the merger, or calculating the cash flow, the discounted cash flow of a company that you don't know very well, that you just have the historical information. If it is a public company, okay, you can download the balance sheet, the income statement, and try to perform the discounted cash flow. However, there are so many variables involved that the decision would be really dependent on if the finance manager is an optimistic person or is a pessimist person regards this acquisition. Because there are so many variables, you need to forecast what would be the sales of a company that you don't work at, the cost of a company that you don't work at, and many other variables in the middle, the expenses. So this is why we normally don't use this approach, because the discounted cash flow is simulating an entire P&L basically of a company that you do not work there. So you can make an estimation. However, there are so many variables that you can risk making a mistake that it's not worthy taking this path, okay? So let's see another interesting aspect that happens a lot. What if the target's stock price anticipates the merger, and the target here is the target company, okay? It's company B. So what does it mean? When there are rumors that a certain company may be acquired by a bigger one, the stock price tends to increase, okay? The market usually recognizes as a good thing, and the price of this stock may become inflated. And that's a problem when we talk about acquisitions. So we will have the difference between two concepts here: market value and intrinsic value. Market value will always be pick the number of stocks, multiply by the share price of the day, and you will have the market value. The intrinsic value here would recognize that the stock price may be inflated or may be understated, okay? So potential investors will see two cases here, okay? We have the outcome, two outcomes, no merger, and if merger occurs, and the market value of B's stocks. If there is no merger, the market will recognize the value of B shares as a separate firm, as it is. But if a merger occurs, or if there is a very valid rumor of a merger, the market will recognize the value of B plus some benefits. Here is some, okay, not come. Some benefits from the merger, okay? So they will already incorporate these benefits in the stock price. Let's see a practical explanation. So before the merger announcement, we have this scenario. Company A, price per share 200, number of shares 1 million shares, value of the firm $200 million. Company B, price per share $100, number of shares $500,000, value of the firm $50 million. So let's say that company A intends to pay $65 million in cash. Then we have exactly the example that I gave you before. The cost is 65 minus 50, that is the market value, equals $15 million. However, suppose B's share price has already risen by $12 because of rumors from the merger. Okay, so the market is already incorporated a benefit from a merger in this stock's price. So it means that its intrinsic value is overstated by 12, okay? And we need to perform the following calculations. $12 multiplied by 500,000 shares equals 6 million, okay? So the true value, the intrinsic value of company B is only $44 million and not $50 million, okay? Because we are considering that this price is already inflated by the rumor of the merger. In this case, we have the cost of this transaction, of this merger, would be the cash paid. It's the same, 65 million, minus the true value of the company, that is 44, not 50. So we have $21 million, okay? So it's a higher acquisition cost when compared to the other scenario in which we were not considering that the stock price was inflated by the rumor of the merger. But since the merger gain is 25 million, it's still beneficial for A's shareholders. But B's shareholders are getting most of the gain, okay? Because we would have a smaller NPV in this scenario, but it's still a positive NPV. Because 25 million minus 21 million equals 4. Another thing that we have to do is estimating costs when the merger is financed by stock. So in recent years, around 70% of mergers have involved payment in form of acquirers' stock, or at least the part of the sale involved acquirers' stock. Okay, so the company would be acquired, but the shareholders would receive part in cash and part in stocks of this new company, or they would receive all the money in stocks of this new company. So if the seller receives n shares, each worth the value of the companies combined, the cost is calculated as, so the cost equals the number of shares times the value of the companies combined minus the value of company B, the company being acquired. So suppose that A offers 325,000 shares, okay, 0.325 million, instead of 65 million in cash. So we are imagining that the transaction was not paid in cash. The acquisition was not paid in cash, but it was paid in shares. So we know that A's share price before the deal is $200. If B is worth $50 million standalone without the merger, the cost of the merger will be, or the apparent cost we say, okay, because we are calculating it before the merger, 0.325 times $200 per share minus 50 million, that is the value of company B, that equals $15 million, okay? So we ended up with the same cost of the merger, but in this scenario, we are paying the shareholders of company B with shares and not using cash. So A's stock price is 200 before the merger. After it tends to go up, right? You are acquiring a company, there will be economies of scale. It's a good sign to the market. Your stock tends to go up. So we can calculate share prices and market value after the deal, okay? The new firm will have 1.325 million shares outstanding. Remember that company A had 1 million, and they issued these 325,000 shares to pay for company B. And they will be worth 275 million. Remember our calculation. Company A, $200 million. Company B, $50 million. Estimated gains from the merger, $25 million. We have 275. So the new share price would be what the company is worth, $275 million, divided by 1.325, the number of shares, that equals 207.55. So the expectation of the stock price after the acquisition will be to increase from 200 to 207.55. The true cost is 0.355 times what is the value after the merger, the post-merger price per share, minus the value of company B. This equation here results in a cost of $17.45 million, okay? So, if you have to estimate the cost of a merger in which the acquisition is made by using shares, by issuing shares or giving shares to the shareholders of the other company, this is how you calculate it. And now let's see some other important aspects involving mergers and acquisition. The first one is mergers and antitrust law. So the antitrust law, it aims to protect competition and avoid monopolies. Every different country will have an agency regulating mergers and acquisitions, okay? So they would have a government body that would approve or disapprove the merger. So recently we had a case here in Brazil with Disney that because of their international mergers and acquisitions, they ended up owning ESPN and Fox Sports channels in Brazil. And we have basically three big sport channels. So the government body decided that Disney could not keep the two brands operating at the same time. They would have to get rid of one or sell one of them. But of course, if you oblige a company to shut down or to sell one of its brands, there will be a lot of unemployment. There are other social consequences. So what did they decide with Disney here in Brazil? They decided that they would have to get rid of one of the channels. So Disney decided to discontinue Fox Sports. However, they need to keep the channel running until January 2022. And the problem is they are already discontinuing the channel, and TV channels, especially sport channels, are not that profitable anymore. There's a lot of competition from YouTube or other media, so there are no buyers. No one wants to acquire Fox Sports here. So they would have really to shut down the channel, and this is what they're going to do. And normally these antitrust bodies, they will sometimes approve the merger, but they will oblige you to discontinue or to sell one of your products or services. When I worked at Coca-Cola, we had a joint venture with Nestle to sell the iced tea Nestea. And after some years, Coca-Cola acquired Leão Jr., that is the biggest tea player in Brazil, from Chamate Leão, and then CADE obliged them to discontinue or sell the Nestea. In this case, they just returned the operation 100% to Nestle. The interesting thing is that Nestea was only 5% of the market, but anyway, the government body decided that they could not keep the two brands. Another important things are the forms of acquisition. So you have a literal merge between two companies. Imagine you have two companies. If 50% of the shareholders, and when I say 50% of the shareholders, I'm meaning in the amount of shares, okay, not in the number of shareholders. So the ones that hold more than 50% of the shares approve, and the shareholders that own more than 50% of the shares in the other company approve, the deal is done, everybody's happy, and the world continues as it is, but now with one company merged instead of two companies. Or you have a situation in which you can negotiate the shares with individual shareholders. And when I say individual shareholders, I don't mean Augusto that owns 200 shares of a certain company. I'm talking about the big shareholders, okay? So they will negotiate with these individual shareholders that own big stakes in one company, and they will negotiate with many of them until they reach majority, and then they are able to complete the merge. This case is called hostile takeover, because you don't go to the management of the company and say, okay, we want to acquire your company, let's analyze a merger. No, you just try to get the majority of the shares, and then in this case you have a hostile takeover. What are some takeover? Takeover is the same thing as acquisition, okay? Some takeover defenses. There is a very famous term in the market that is called poison pill. So the management of the company can try making the company more unappetizing, okay? So that the other company would say, acquiring this company may be a problem. How can they do this? And of course, they cannot do something that would do harm to their own company. But they can use strategies as existing shareholders. You can issue some rights to existing shareholders in which if there is a significant purchase of shares by a bidder, they can purchase additional stock in the company at a bargain price. And then what is the problem? It would dilute the stock price. So you would make a big investment to acquire this company, but at the same time you have shareholders there that will be able to buy more shares by a smaller price. There are a lot of mechanisms like this that a company may use to protect itself from a hostile takeover or from an attack like this. And usually it happens when the management team is defensive as well, because they might be afraid that they will lose their jobs with the merger. So there is another technique called golden parachutes. How does it work? It involves general payoffs to managers, and when I say managers, I'm talking about the top management, okay? Managers, the people who are running the company, the CEO, the CFO, the CHRO, the COO, the Chief Marketing Officer. When I say managers, I'm talking here about C-level. So, in the case of a merger, they already make an agreement that these guys will receive a big payoff if they lose their jobs after the takeover, okay, after the acquisition. So they will be less resistant, there will be less conflicts of interest, okay? So they say, okay, you are the president of company B. If company A acquires company B, the CEO of company A will remain as the CEO, so there will be no space for you. But if you work together in this merger, if you keep with us in this process, after the merger is concluded, if it is concluded successfully, you are going to receive a big bonus. This big bonus is the golden parachutes. So the parachutes, imagine you are jumping from the plane, but you are jumping from the plane with a bag full of cash. So this would be another strategy when the management team is too defensive or is causing trouble for the merger to be successful. And what are other players involved besides company A and company B? You have investment bankers. Usually we'll have an investment banking coordinating all the process. You have investment banks that a lot of, or all investment banks, they will have the M&A department, and these people are always analyzing who can buy who, which companies would be interesting to see merged, and they will work more proactively for it to happen. Or they may be approached by another company that wants to acquire company C, for example, and they will conduct the process. You have lawyers, of course, involved in all aspects of paperwork and in the due diligence together with the accountants. The accountants would be involved in audit processes as well. And you have the arbitrageurs. So in cases in which there is a disagreement with the two parts, so let's say that we have a merging process, but during this periods after the contract signed, there are conflicts between these two parts, and usually instead of going to a normal court, they will go to an arbitrage court or an arbitrage house. Usually they are in Switzerland, most of them, and these arbitrators, they will decide who is correct in this conflict, and it doesn't matter the decision, the other part will obey. Okay, so it happened with Pão de Açúcar and Casino. Abílio Diniz, that was the owner of Pão de Açúcar, had a disagreement after the merger was signed with the management team of Casino, and it was only solved in an arbitrage house and in favor of Casino in that case. So this is it for today, but you have an assignment. I want you to select an M&A, a merger and acquisition case, and explain it with your own words in 15 to 20 lines. I want you to tell why did it happen, so why these companies decided to merge, what were the benefits from this merger, what were the cons of this merger, what are the amounts involved if you have access to the balance sheet, to the income statement. But I want you to write a summary of this transaction, of this merger and acquisition, and I want you to post it into the forum. Next week we'll have class 8, that is the last class of the corporate finance course, of the corporate finance module, and we will have a review of everything that we have seen. So assignment 7 is mandatory for you to have your certificate, okay? So for you to have the certificate of conclusion of this course, you need to select your M&A case and post your summary in the forum. After these, and after class 8, of course, you will be able to receive your certificate. So you just send me a message. Send a message to augusto@outliers.com.br telling me, Augusto, I finished the course and I posted assignment 7 in the forum. Can you issue my certificate? I'm going only to check, and I will issue your certificate, okay? So thank you very much, and I'll see you next Thursday. Bye-bye.